The hidden dangers of buying the dip. Why it's not always the right move. Buy the dip is a phrase that has become almost a mantra among investors. It sounds simple when stock prices drop. You buy more, hoping to profit from the inevitable rebound. But here's the truth that many investors don't realize. Buying the dip blindly can be a dangerous strategy. You may think you are getting a bargain, but in reality, you might be catching a falling knife, investing in stocks that continue to drop due to deeper fundamental problems. What are the risks of buying the dip blindly? Buying the dip can work well when the dip is due to short-term market fluctuations or temporary setbacks. However, when a stock's decline is caused by underlying issues, such as poor financial performance, weak management, or a shifting competitive landscape, buying the dip can lead to significant losses. Think about it this way. If a stock is dropping because the company is fundamentally weak, it may continue to decline, erasing any chance of recovery. You may find yourself holding onto a stock that keeps losing value, hoping for a turnaround that may never come. This is often referred to as catching a falling knife, and it's one of the most common mistakes investors make when they follow the buy the dip strategy without proper analysis. For instance, during a market downturn, some companies may see their stock prices fall due to broader economic factors. But if these companies have weak financials, poor management, or outdated business models, they might never fully recover. In this scenario, buying the dip can trap your money in underperforming investments for years, preventing you from capitalizing on better opportunities. It's important to remember that not all dips are created equal. A temporary dip in a strong company can present a buying opportunity. However, a dip in a weak stock often signals deeper problems that may not be immediately apparent to the average investor. If you continue buying into these dips, hoping for a reversal, you could end up with a portfolio full of failing investments, leading to a significant erosion of your wealth. The smarter approach focus on strong fundamentals and future growth potential instead of automatically buying the dip. A more effective strategy is to focus on identifying stocks with strong fundamentals future growth potential. What does this mean? It means looking beyond the price drop and examining the company's overall financial health, competitive position, and potential for long-term growth. Strong fundamentals are the backbone of a company. They include factors like steady revenue growth, a healthy balance sheet, a strong market position, good management, and the ability to change in market conditions. These are the companies that are more likely to recover from short-term setbacks and continue to grow over time. By focusing on stock with solid fundamentals, you're not just buying perceived value, you're buying quality. When you invest in companies with strong balance sheets, good management, and clear growth potential, you're positioning yourself to benefit from future growth rather than hoping for a rebound in a weak stock. For example, during the COVID-19 pandemic, many companies saw their stock prices dip dramatically. However, those with strong fundamentals, such as tech giants with solid revenue streams and innovative products, recovered quickly and even thrived. Investors who focused on these quality stocks rather than just buying any dip were able to enjoy significant gains while minimizing risks. When you focus on buying quality stocks with strong fundamentals, you position yourself for higher returns and less risk of permanent loss. Here's why. Companies with strong fundamentals are more likely to grow over time. They are better equipped to weather market downturns, adapt to changes, and capitalize on new opportunities. This resilience often translates into higher returns for investors. Investing in strong companies reduces the risk of permanent loss, even if the stock price drops temporarily. A company with solid fundamentals is more likely to recover. This minimizes the risk of holding a stock that becomes worthless. By focusing on quality, you're making investment decisions based on data and analysis rather than emotion or market hype. This disciplined approach helps you avoid common pitfalls, such as panic selling or doubling down on losing investments. Knowing that your investments are in companies with strong fundamentals gives you confidence to weather short-term market fluctuations. You're less likely to make impulsive decisions based on temporary dips, allowing you to stay focused on your long-term goals. The buy the dip strategy can work, but only if you approach it with caution and focus on quality. Don't fall into the trap of catching falling knives by buying stocks continue to decline due to fundamental problems. Instead, concentrate on finding strong companies with the real growth potential. By doing so, you set yourself up for higher returns, less risk, and greater peace of mind. Remember, investing is not just about buying cheap, it's about buying smart. Prioritize quality over perceived bargains, and you'll be better positioned to achieve your financial goals in the long run.